All right, so in this video, we're going to wrap up our series here on the workbook exercises for Chapter 4. And this will be the last one here. As I mentioned, we're going to be looking at AP 7B. And AP 7B has a couple of different things we need to do. So the first being very similar to what we did in AP 4B, just creating all the journal entries for a number of different transactions. That'll be our first part. The second part is going to be posting those journal entries to the individual ledger accounts. So we've got a whole listing of ledgers for all the different accounts. You can kind of think of this whole set of accounts as the general ledger, and then each individual account will have its own ledger. So cash here has its own ledger, accounts receivable, so on and so forth. And then the final section will be to use the ledger account ending balances to create a trial balance here and make sure that all of our debits and credits balance. All right, so let's get started with the journal entries. So this problem gives us beginning balances, and that will come into play when we're looking at the ledgers. But for now, let's focus on the journal entries to begin. And so we've got a whole number of transactions here to work on. I'm going to again copy over our dead circle just to have it available for reference, just to help you all get in the habit of doing that. And let's look at the transactions. So the first one says that we paid $1,800 cash in advance for a 1-year insurance policy. So remember that this is prepaid insurance. That's an asset. And cash is also an asset. So cash asset is going down. Prepaid insurance is going up at this point. We haven't, this isn't us using any of this insurance yet. This is just the September 1, the very initial payment in our dead circle. Assets are increases with debits. So prepaid insurance asset will increase and cash asset will decrease. We'll say paid for a 1-year insurance policy. That's $1,800. And we're looking good. Okay, September 2nd, we received $1,900 cash for services provided. So cash is an asset, so the debit will be an increase. And then the other side is revenues increasing, and revenues increase with a credit. So we have cash and revenues and 1,900, and we'll say received cash for services. Okay, September 3rd, we paid $1,350 of cash for September's rent. So technically we really could record this to prepaid rent, but because it's at the beginning of the month, but there's no real benefit to recording a prepaid rent and then having it be expense at the end of the month. Typically, you're only going to record a prepaid expense when it's multiple months. Like here, we've got 12 months, 1 year. So we're going to increase our expense. So expense increase is a debit, and we're going to decrease our asset. So the asset decrease is a credit. We're going to say rent expense and cash paid for rent. Pretty straightforward. And how much was this? $1,350 there. Okay. All right, September 4th, we purchased office supplies on account worth $250. That's important. So office supplies are an asset, and so we want to increase that with a debit. And then on account tells us where it says this, we didn't pay the cash yet. It's on account, so we have accounts payable. We have a liability that we're going to owe. And we're going to say purchased office supplies on account. And how much? $250. Keep with my theme of just linking there. Okay, September 10th. This one's a compound journal entry. We talked a little bit about that in the lecture. where typically, you see in a lot of these 2 account entries, just 1 debit, 1 credit. But in this entry on the 10th, we're actually going to have 3 different accounts that we're going to be touched here in this journal entry. So we paid $960, so we know right away when it says that cash will be decreasing by $960 towards the bank loan principal, so a liability will be decreasing, and for a portion of that is $40 of interest, and so an expense will be increasing. So let's do the liability decreasing first. So remember, liability increases with the credit, so we know it decreases with the debit. So we'll say notes payable, and then we have interest expense. And this should be formatted to the side because those are both debits. And then we're going to have cash as our credit as a reduction there. So we paid $960. We know that. The interest expense was $40. And so here we have to just do a little bit of math to take the difference between those two. So I can do a little formula just to do the math for us. So 920. And here you can see the 920 plus the 40 is 960. So our debits and credits are in balance. And we can say paid bank loan. So this is a good example of how you can have these compound journal entries. It doesn't, and it doesn't have to be any given number. You could have 100 debits and 50 credits, or 1 credit and 100 debits, or 1 debit and 100 credits, and so on and so forth. You could have any number of lines in a given journal entry, but the key thing that is required is that the total debits equal the total credits. Okay. All right, September 20th, we received $2,200 of cash for a customer booking consulting services in advance. So we know that cash increased. And cash is an asset, so it'll be our debit increase here. And then remember, this account that we're going to use when customers prepay for us is called unearned revenue. We have not yet earned the money that they've given us. It is unearned revenue at this point. And it's a liability. So liabilities increase with the credit. And we're going to say customer prepayment. Okay. September 22nd, so here we are, we collected $850 from a customer paying their account. So let's translate this here. So right away we know we got money, we collected cash. Cash is an asset, debits are an increase to assets, so we increased our cash by $850. And when we see this terminology, a customer paying their account, that's essentially saying they had a balance owed to us. We on our side, as the provider or the business, would have recorded that initially as an accounts receivable increase. So now that they're actually paying us, it's going to be an accounts receivable decrease because we're no longer going to receive this amount because it's already been paid. And we'll just say customers paid their account. So these are both assets. Cash asset increases, and then the accounts receivable asset decreases. And this is, as I talked about previously in the last workbook exercise problem, the second part of a 2-part transaction anytime there's accounts payable or receivables. The first transaction would have been us earning revenue and increasing the receivable, the accounts receivable, and then this is the second part of the series that's always going to happen at some point. We don't know when the customer will pay us necessarily, but this is what it's going to look like when they do, with us receiving the cash and basically writing off the receivable or decreasing it to 0 to represent that for this portion of the receivables, we have now received them, And so we don't need that placeholder anymore. All right, September 24th, we paid $600 towards accounts payable. So remember, accounts payable is a liability. It increases with a credit, thereby it decreases with a debit. And we paid the cash, that's an asset, the credit is a decrease, $600. And again, this is kind of just like I mentioned, this is the second part of us receiving money and using accounts receivable. This is the second part of what would have been two different journal entries. The first one to increase accounts payable when we purchased something earlier, and now this is the second part where we're actually paying that accounts payable off, and so we no longer owe this $600 amount. Yeah, decreasing assets and liabilities. Okay, and finally on September 30th, the owner withdrew $1,600 of cash for personal use. So that's going to be the draws or owner withdrawals. That's a debit. So in this instance, we have a specific account. It doesn't, I'm trying to see if it shows it here exactly. We're going to reference the owner. This is just kind of a typical formatting thing. As far as the owner's equity goes, we're going to identify which owner it was. We just have the one really in this instance, so low capital. So we're going to use an account of withdrawals that is specific to that owner. So we'll say low, who is the name, and then withdrawals. And it's going to be, how much was it? $1,600. So the owner takes out the money decreases, the asset goes down. And we'll just say owner withdrew cash for personal use. Okay, so now we've journalized, if you will, all of these transactions here. So this is our general journal. It's chronological order. We have all the debits and credits in place. And the next thing that we need to do is to take these journal entries and post them here to the general ledger. And so to do that, we're also going to need to fully complete our ledger, we're going to need to go through and do beginning balances. This is kind of familiar, hopefully, to you all. It's similar to when we were working with the T accounts originally and we had to put our opening balances in. We're going to have to do the same thing. It's just that the activity that the opening balances and the debits and credits are going to be put into the specific ledger accounts, not the T accounts like we used previously. Okay, so let's take a look here. We've got cash of $7,200. So let's put that in here as our opening balance. And the way we can do that opening balance is just to type that in here. And then as we go through and post the journal entries, we're going to have debits and credits here. We're going to indicate it's a debit normal balance. So the $7,200 is a debit balance is what we're saying there. Okay, that's cash. We got accounts receivable of $2,300. Debit normal balance again. And note that we're putting these opening balances in all here at September 1st, the first day of the month. And you could have additional transactions that happen on the 1st. It doesn't have to just be one transaction, only one date per line. But we do want to put opening balances at the opening point of the month. Okay, office supplies had $850, so let's come down to the office supplies account. Okay, and then equipment had $11,500, so we'll come down here. Okay, so that's all of our assets. And then let's start looking at our liabilities here. And we had, and you can see, hopefully you're following me, you can toggle between these. That's important here. So accounts payable had a $3,400 opening balance. And remember, the liabilities increase with a credit or have a credit normal balance, so CR for credit. $1,400 in unearned revenue. $5,600 in notes payable. Again, it's a liability, credit normal balance. And just to highlight that, what this is saying is the balance that's being reflected here is a credit. And then when we journalize, when we bring the journal entry impacts over, they will go in their own debit or credit column. So just kind of two different ways to show this is a credit. When you'll see input here, you'll be able to know it's a debit or credit just by the column that it's in. Okay, so notes payable was $5,600, and then we had the capital account was $11,450. And remember, capital, just like contributions, really you can use either term in there under the C on dead circle, and it's a credit normal balance. And we are looking good. Now we're going to go through and put that was all of our opening balances. And now we're going to go through and put our journal entries in. Okay, so let's just go entry by entry, journal entry by journal entry. So the first one is an increase on September 1st to prepaid insurance and a decrease to cash. So let's start with cash just because we're right here. So one easy way to kind of do this is to go to your ledger, and we want to put this cash so you can see it was a credit to cash on September 1st. So we're going to go here to the ledger. I've already put all the dates in, so that is something that you don't have to mess with here. But then we can just go equals, and then you can click into this other tab and click into the cash journal entry there. I find that to be kind of an easy way just to link everything. And the way that these balances are going to work in the ledger accounts is that this is a debit balance. And so if we were to debit that, remember, a debit to an asset is an increase, a credit is a decrease. But we're crediting, so we're decreasing cash. So we're going to take the previous balance minus this credit amount. And I'm just going to drag that out because it's still a debit balance. But now we've got $5,400 as our balance in cash. But that was just one half of the journal entry. The other piece went to prepaid insurance. So it had a 0 beginning balance. It had no beginning balance to start. But now on the first, we are going, and I guess you could put a 0 in if you really wanted to. Let's do it just to practice seeing how the debits and credits impact the balance there. So the prepaid insurance gets debited, and then our updated balance, then remember, debits increase assets. We have a debit balance plus a debit gives us an ending debit balance after this journal entry of $1,800 in prepaid insurance. Okay, so we've accounted for that journal entry number 1 there. And then we're just going to go through and do the same thing for the second. So here on the September 2nd, we've got cash. Oh, and one thing that actually we should do, I think it's handy, go ahead and link, so we can say equals, and then we can link to the actual description that we typed in on both sides, because this is really what you'll see. In modern accounting software does this for us automatically and updates the general ledger automatically, etc. But it will show you when you go back through to look at the ledger account. Really, it's beneficial to have these descriptions, because then you can see all these debits and credits that affected this cash account, for example. You at a glance will be able to see what all the different transactions were for without having to go to the journal entry specifically. So let's link those. I think that's
That's important. Okay, September 2nd, we had cash going up and service revenue, so cash was debited. So we'll link over here to cash. Again, we'll link the description. I'm going to show you one thing because this is, I want all these explanation spots to look the same. So I'm going to use this tool called Format Painter because I want them all to look like this up against the margin, no italics, etc. So I think I had not pre-formatted these. I'm realizing just now. But this tool here, I can click Format Painter and then paint it over all the cells I want to have. And since I selected this formatting first, now it's updated. And I'll save this down so you won't have to do that same formatting. But do keep in mind the Format Painter is a pretty handy tool for quickly changing italics, and all that kind of stuff to match a different cells formatting. Okay, so here we now have an increase to our cash. So now we're at 7,300. And the second part of that entry was for revenue, service revenue. What date was that? That was the 2nd. So now we go down to service revenue. And it was a credit, so we'll link that. Let's link our description. And we now have, we can just say equals, and it's a credit balance. So now we have 1,900 in service revenue. Okay, and let's keep working through. The next one was a decrease to cash and an increase to rent expense. So let's start with cash. So now we're crediting cash. Let's link in the title there. Oh, that didn't work. Why did that not work? Maybe when I think I need to change the formatting actually there. Bear with me for one moment. Yeah, okay, so if you change it to just the text format, that didn't work. But again, you will have this formatting done, so you won't have to mess around with this stuff. But I'm going to do that because it was not bringing the text over like I wanted. So now we've got, remember this, that was a debit balance minus our credit balance. So after we reduce the payment for rent, our cash running total is now $59.50. But that was just one half of the journal entry there. So we need to put the expense piece in. So let's go to the rent expense. And expenses are debit increases here. And there's only that one transaction, so we're just gonna, we don't have to account for a running total yet because we just had one transaction. Okay, let's go to our next journal entry. So office supplies and accounts payable. So we increased office supplies, and this was on the 4th. So we had a debit to office supplies here. Link our explanation. And then accounts payable was the other part of the entry there. The credit, let's put our explanation over. And don't forget, as I was doing this, so we have a debit, we've increased our office supplies account, so we want to add these two together to get 1,100. And similarly, for the liability side, we want to add these together here, where credits are increases to accounts payable, to liability. So now we've increased a liability and we've increased our asset here by doing that.
Okay, let's keep working through. So here on September 10th, we decreased notes payable, recorded interest expense, and reduced cash. I'm going to start with cash. I just start at the top of our ledger here. But we credited cash $960. So this is our running total. It was a debit, so we're decreasing further because we made a payment. And this was paying the bank loan. And let's find notes payable. So here we're debiting our notes payable to reduce it by $920. Payment for the bank loan. And here we're noting, as I just mentioned, is a decrease to a liability is a debit. It's a credit balance. As we debit it, that means we're reducing the amount of the loan. And there was an interest expense portion as well. And expenses are debit, increases. So here we are, $40. No other amounts to account for in terms of what was coming before necessarily. It's just the first expense that we've recorded. It's a debit balance. And we've got that all recorded. Okay, let's look at our next transaction here. And I'm just kind of highlighting these as I go just to draw my eye to the right spot. So little things you can do in Excel. I'm not doing anything to those cells, but just holding my mouse clicker button and just highlighting it so it's easy to see. And when you highlight something and go between worksheets here, it still maintains that highlighting, so it's kind of a nice way to look at it. And so what we want to do here is increase cash and increase the unearned revenue liability. So we debited cash, $2,200. Put the explanation in. So now we're going to increase our running total. And we need to find the unearned revenue liability, and that was a credit. And we've now increased that liability. And let's put our explanation in. Okay, so I think we got both sides there. Let's look at the next one here. Okay, we got a receipt of cash and it decreased the receivables. So let's go and start with cash. So we had a debit to cash. And again, we're just going to add that to our running total. Put the explanation in, and here we've got a decrease to accounts receivable. So that was a credit to accounts receivable of $850. We'll link our explanation, and then this will be a reduction. So the balance before it minus the $850 brings it down to $1,450. So we do still have $1,450 of amount that customers owe us. That's what that basically represents. But we reduced it. Previously, all different customers. This could be one customer. It could be multiple customers. Somewhere behind the scenes, there's a listing called the accounts receivable. They call it an aging list because usually it has an age. If the receivable is older, we want to know that because that means that the customer hasn't paid us yet and maybe they forgot about it or something. And so anyway, there's a list called a subledger behind accounts receivable that would show us who are all the customers that owe us money that would total up to these amounts here. But we did get paid, so we reduced the amount that's owed to us. Here we're reducing a liability and paying cash. So cash is being credited. for 600. So we're going to reduce our balance there. And let's not forget our explanation. And let's go to accounts payable. It's our debit for accounts payable of 600. So we're reducing accounts payable. Okay, we've got that all listed in there. And our final transaction here was a withdrawal with cash being reduced as the one component for 1,600. So that will reduce with the credit to bring us to a $5,840. We still have a debit balance, so this 5,840 is a debit. And I'm looking at my answer key on the side, and I think I'm off by a little bit, so I want to make sure I didn't miss something here. Something looks a little funny with this one. Let me review that and say, so we had 960 on the 10th. Oh, I think, what did we do? Let me look at this journal entry again here. So, oh, I see. Okay, sorry. Bear with me here. You'll need to go back and correct this as well. But since we're linking everything, the value of doing all this linking, this amount is actually wrong. I'm just realizing. But since we've linked everything together, we should just be able to correct it, do our correction here, and then all of the linking should correct, automatically. It should just come through and fix itself essentially. I was misinterpreting this to say paid a total of 960, but really what this is saying is we paid 960 and $40, but 960 was the bank loan, 40 was the interest expense. So that was a little confusing. So what that means is that the total cash paid was 1,000, not the 960. And then here we can see now this updated because we have it linked to automatically show the 1,000 instead of the 960. So hopefully with that correction, then you can see, and then everything else just automatically adds up because these are all links again. So when this automatically now references the correct amount from this cell, it will update and you don't have to worry about typing in the formulas or anything like that. So that's really the power of linking, is that when you make a correction, it just carries through to all the other accounts. And I'm just taking a quick look through here, make sure everything looks good. We didn't have any activity in the equipment account, so we don't see any changes there. We've got our explanations, and the power of these explanations is just, that we're able to look through a general ledger like this relatively quickly, especially for an account that has a lot of activity like cash here. You could look through and understand at a glance. Oh, with that said, I just realized we didn't put the final explanation in there, but at a glance we can quickly see what is the reason for this debit or credit to that cash account. So you can also see that here in the ledger. It's just a different way of looking at things. So this is by transaction, and then this is if you want to just drill into one specific account like cash, for example. Okay, so let me get back to just glancing through. Make sure we've got our explanations all input. It looks like we've got our formulas done right. Just doing some self-review. This is important as an accountant. We're not in a rush. This isn't a race to get work done. It's a really an attempt to make sure that we didn't miss anything. And I can actually see here, I think that was the other part of this transaction that I forgot to put in there. So see, when you go back through, you take your time, you'll end up finding areas where you might have made a mistake. Typically, again, in the modern accounting software world, a lot of this would be computerized and you wouldn't run into the potential errors like I just did, where I had put the 1600 in here for the credit part and done that to the cash, but I had forgot to put it in the withdrawals account. So we were off balance at that point. Computer software nowadays would prevent that from happening, because what we're doing here with posting to the general ledger is done automatically. But it's a good exercise to do it by hand like this so that you get the experience of what the software is actually doing. And also, it's a good experience just to have that process of doing self-review, etc., because that is a really important thing. I'm just realizing, again, self-review is that I included 2 service revenue accounts, so I'm just going to delete that set of information out. Again, in your copy that you'll have to work off of, that will already be removed, so you won't have to delete that. Interest expense. And again, if you were to look at this, you could just really quickly, oh, okay, what was that for? Oh, I paid the bank loan. Okay. Rent expense. Some of those are pretty self-explanatory, but especially when you have cash or these accounts payable or something else, especially cash where you've got a lot of transactions, and these are all for a variety of different things. This really helps you understand what the reason for these debits and credits is, like I said, at a quick glance without having to reference back to the general journal and try and figure that all out. Having the explanations right here is quite handy. Okay, let's just go through real quick. Make sure it looks like we're not missing anything. Okay, so I think we've got everything in here. Now our general ledger is updated. So we did our journal entries in the first part. Now we've updated our general ledger. We did self-review. We looked through and we made sure that we weren't missing anything. And we got that looking pretty good. And now we're going to go to the final section, is to prepare our trial balance. And so really with the trial balance, all we're doing is just pulling in the ending balances here. And this is going to tell us whether we balance it. So technically this would be the point at which I would have caught my error, because, or at least the error would have become apparent where I didn't put in the withdrawals. Second, I put the cash but not the withdrawals part into the ledger at first. And so if we had prepared our trial balance now, we would have caught at that point that something only got posted up in one spot on the ledger, and both pieces, the debit and the credit, were the credit piece, or the debit piece was missing for withdrawals. I caught that in self-review, but that's what the trial balance really does for us, is it helps us do that analysis, especially in a manual environment like this. As I mentioned, with accounting software, it becomes less of an issue because the software does a lot of this work for us behind the scenes, and it basically prevents these types of one-sided, those kind of errors from happening, or at least it'll catch it right away and give you a warning. Okay, so now I'm just going through and putting the ending balances in for each account. And this is their debit or credit balance. So it's a credit balance, $3,600 for unearned revenue. So it's just all the ending balances basically. Notes payable has an ending balance of $4,640. So capital. Now remember, our withdrawals has a debit balance. It's a reduction to capital, so you can kind of maybe logic out why that would be different. Service revenue, that's $1,900. And then the expenses, interest and rent, 40 and 1350. So again, we're just linking everything so that if we did go back and make a change because we made a mistake or something, we'd be able to, it would just flow through because we have all these links and automation built into our spreadsheets, and it prevents us from having to correct in multiple places. So then we just add up all of our debits, and that gives us 24,640. Our credits 24,640. So awesome. So again, so I had originally made this mistake of leaving off the debit part of that final journal entry here. I had put the cash component in, but I got sidetracked and missed the debit to withdrawals. So I just deleted that to show you that if I had done that and not caught it on self-review, but then I prepared my trial balance, you would see that we would have been out of balance because something would be missing, which that something would be the withdrawals piece. And so I'll put that back in. Actually, let me link that. Speaking of linking, let's make sure that we do all of our linking. So the more linking we can do, the better, usually, just because if we have one source of initial input where we have to actually type the thing in, and then we just link it through to all the rest of the pieces that connect to it, then if we change the initial source, all of the connecting pieces here downstream will just automatically update. And you can see now our debits and credits do balance. All right, well, thanks everybody. I know this is a relatively involved problem, but I think it's a really good problem to show you a lot of bookkeeping here and what bookkeeping is like and how these the general ledger and this individual ledger accounts work, and then how those all get summarized and how it flows through with the running balance, and then finally gets brought to a trial balance. And then the next step, which this problem doesn't specifically ask us to do, but the next step in the process would be to take these ending balances then, and we could prepare financial statements with this information. We could prepare a balance sheet. We could prepare a statement of owner's equity, and we could prepare an income statement very easily just because we have all the ending balances here. Again, this problem doesn't ask us to do that, but that would be the next step in the cycle. So hopefully you're starting to get an understanding of the whole flow of this accounting cycle. Like I said, we're not doing that final piece of it, so this is just a portion of the accounting cycle, but this is extremely important part of the accounting cycle, especially making sure that the initial part of analyzing source documents and putting the journal entries in is done correctly, because if you make errors here, then those errors are going to show up in the ledger, and your trial balance will have errors, and then your financial statements will have errors. So being sure to go slow, do self-review, and ensure that your work is accurate is really important for the overall outcome. All right, well, thanks everybody. That's the last video here. This is the last problem in our workbook exercises for chapter 4. Hope this was helpful. As always, reach out to me if you have any additional questions, and we'll work on some more examples in class. And I hope you all are having a nice day, and I will talk to you soon. All right, bye everybody.